Tim, you just heard from
Good
Dom
morning.
about what the CFO's outlook is, I should say. I know you're watching the credit market very closely, though, and we're seeing a lot of worrying signs there. What's your read on everything all put together?
Unfortunately, the bond market and credit markets are always ahead of the equity markets, or at least the equity markets should be taking their leads. And what we've seen in terms of a credit deterioration over the last 4 or 5 days, and I mean even over the weekend, a couple new funds have come forward and dumped a lot of liquid securities on the market. So without getting too deep into the world of asset-backed securities, mortgage-backed securities, and the entire credit curve, what we've seen is a need for liquidity. What we've seen, and even a request for, to the Fed, to the market participants, to bring more liquidity, to bring a TALF-like plan. Credit markets right now continue to, I think, set the stage for potential more deterioration, but at a minimum, trying to understand where the credit damage is, which is difficult at this point, is part of what an equity investor needs to do. And certainly, as we saw the futures at their worst last night, a lot of this was feeding through out of credit anxiety.
I know you're looking at the market sort of as a whole there with those commentary about the credit markets. When I was looking just at the retailers and seeing at least 14 by my count in the last couple of days drawing down on their revolving lines of credit to shore up their balance sheets, many of them are doing it as padding. Their stores are closed. They don't have revenue coming in. It's sort of a blanket on a cold night, as someone described to me. It's not necessarily because of a dire consequence. So if I'm an investor, how do I evaluate between the two, between what's padding and what's absolutely necessary or else?
Yeah, look, this is beyond a cold night. And if you think about the impact on free cash flow and the impact on balance sheets right now, they should be reeling in whatever that they have available to them. If you look at equity markets and if you look at how companies have to address the business cycle right now, it's really unforeseen territory where effectively you've frozen, in many cases, the revenue stream. Certainly, as we look at the small business, and I think we're all trying to assess what is going to be the impact for a country where 70% of the country is geared off of the economy is the small business. The good news for equities at some point, though, as we look at market dynamics, is this has been as aggressive and as extreme of a sell-off as we've seen, arguably, even through back to 1987. The crisis, obviously, in aggregate terms, was bigger, but the crisis took place over the course of really 9 months. Obviously, the extreme was the fall of 2008. But right now, equity exposure is almost 2.5, actually 2.5 standard deviations below average. Simply put, people have delevered. The market participants across the board, from hedge funds through to retail, we've seen a massive sell-off here.